Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I've alluded to this, how to stay with big winners, but it's real simple. It's only take half of your position off if you hit, in my case, 100% or more. Now, you can change this and tweak it. If you're trading real conservative, you might tighten it up and maybe look for a 50% gainer as a place to take part of your profits off. That's okay, too, but I just want to make sure that you're getting your risk capital back out of the trade. And what I find that does is we call it the free trade rule, that basically once you get your risk capital back, now, whatever you've got left is basically the free trade. You don't have any, psychological worry about losing the capital you put into the trade. Now it's just about, can you really ride the trend? Can you stay with your indicators? Because I find so many people just frankly don't follow their indicators. You've got to make sure that you get rid of the emotion so you can handle it. This means that you never want to overcommit your capital in any one trade. For example, for us, usually we're talking about putting 5 to no more than 10% of the capital we allocate for any trading program into a trade. Even if you say, well, it's only going to get me 1 or 2 contracts. That shouldn't be the concern. The concern is basically following a plan consistently so that no one trade is going to make or break you. But if you've got a probabilistic edge, if you've got an advantage, think about the Vegas casinos. They have an advantage. If you play enough hands, the reason they want you to sit at the table longer is they know the more hands you play, the more their edge over time eventually kicks in. The last thing they want is for the jet-setting multi-billionaire to come in and put $1 billion down on one hand, get lucky and win, and then walk away. That's the if you're betting in Vegas where you don't have the edge, you'd want to put it all down in one hand and take your shot if you had to bet, and then if you win, walk away. If you lose, of course you're going to walk away. But that's not how we want to trade. If we have an edge, you should have an edge to trade. That's what I'm showing you here are several of my favorite edges. But bottom line is that, if you've got an edge, now your goal is don't get greedy, don't get overcommitted. And that's something that a lot of people forget, because you start making money with this method and you start feeling like you're invincible. You start feeling like, wow, this thing is the greatest thing since sliced bread. I don't want you to ever think that, because frankly, there is no holy grail. Every once in a while, you're going to get a negative surprise, and it's going to happen where you're going to have to learn how to, when they don't, and I would say, frankly, you're going to have to be on some of the choppier markets, you're going to have to be prepared for half the time getting quick little stop outs versus the other half of the time getting bigger winners. So the question is, are you disciplined enough in those kind of, even in choppier markets, to say, okay, I can take a quick stop, I can accept that risk. And if you can't accept the risk, then you shouldn't be trading. The bottom line is that you've got to make sure that you trade small enough so you say, look, when this stop hits, I'm gone. What I see too many traders do is they load up on an idea thinking, I've been scouting this forever, I've been studying it. They load up, and then when the stop hits, they go, well, I'm too exposed now, I'm feeling too much pain, I'm going to wait for this thing to snap back up, and then I'll get out. Well, of course, you know what the rest of the story is on that. Most big losses start out as what? As small losses, right? That the idea is that, we're looking at a situation in which you've got to make sure that you don't get caught in that trap, because that's truly where most traders really get hung by just getting caught and then basically feeling like now they're stuck, they can't get out, and we don't want you to ever feel stuck. The indicators won't allow you to do that. So Bob says it appears that the percent R and the acceleration bands duplicate each other, which takes precedent. Good question, Bob. Certainly, our goal is that whichever one will typically signal first. A lot of times it'll be percent R, frankly. I originally developed acceleration bands back in the 90s when I was mainly trading a lot of the tech stocks. It's how I basically built my own capital up to start Big Trends after being head of research for another options-oriented trading firm and research firm. And the bottom line is that, that was great in the 90s because, it told me when to get in. It also told me when to get out when they were rolling over before the tech collapse. But, since then in the 2000s, I've learned that you can't just buy breakouts and expect that they're going to keep carrying you without defining your risk point first. That, you've got to define a much tighter risk point in these markets. That's what the percent R really, I found after looking through so many different indicators, literally testing hundreds, if not thousands, of different ideas that we had internally as well as externally from subscribers, saying, bottom line is, which one gives you the best risk reward? It's not just about how much you can make, it's also about how little you can lose. If you can keep your risk reward down to where even if you're only winning half the time in options, and you think that doesn't sound very good, but if I can lose, for every 1 point I lose, I can make 3. If I lose 2 points, I can make 6. The idea being, if I can get a 3-to-1 reward to risk ratio on my good trades riding versus my bad trades, quick losses, get out fast, that's going to be as important to my success as what my ultimate winning percentage is. So what that means is we're going to take stops a little bit more quickly, which means we're going to hurt our winning percentage a little bit, but we're doing it to protect our capital and to make sure that you do the same, and then also make sure that you're around to play for the next one. That so many traders get stuck in that thought that I did all this research and all this watching, and I'm finally in, and now I'm like waiting, and that's not what you want to do. You want to be in a situation in which, okay, if you're right, you ride. If you're not right, you cut bait and move on. Have you ever noticed that it's much easier to be objective when you're not in the trade than when you are? If you're having that problem, you need indicators like these that will allow you to still stay objective even while you're in the trade, because the indicators don't lie. They don't change later. There's no second guessing. It just makes it real clear. So the basic rule here is that once you've sold half of it, you want to ride the other half position until it does one of two things. It gives back half of its gains from its peak. So say it went up to 150% gain, then it goes back to plus 75. We're going to be cutting and running at that point because it's given back half of its peak gain. Or if it doubles once more, if you've got 4 or more contracts, you sell two of the 4 at a double, sell one of the remaining 2 if it doubles on top of a double. Obviously, those moves are fairly rare, but when they happen, they're nice to scale out of and still not get out of totally. You still keep taking a little money as the market makes it available, but you also don't bail out of all your positions. So here's a case with EUI where you can see EUI had been a really nice example where the U.S. dollar was really dropping back in 2007 very, very steadily compared to what we were seeing happening in the euro. And you can see these retest points that were coming in. It's giving you great low-risk entry points to get back on board. So if you miss one phase of a trend, the beauty of the retest method is it'll get you back on for the next pop, the next chance to ride it back down. So look at these 3 retests that we had here, and you were able to catch, it's all about a good low-risk entry point, able to catch another move down. Let's say that you missed those and you went ahead and took this next one back in late November. You say, well, you can see what's going to happen. There's our retest. It's going to take you out the very next day. So you see how when you're wrong, bam, goodbye, moving on, got to get out. And so at that point, the trend is changing. You can see, of course, what had happened here back in 2008. You can see that we were getting the breakdown. We're now bear confirmed the very next day in late February, down at about just around 66 on the EUI value. You can see it went down to about the 63 area, and then it started to snap up. There's our retest coming in. We were telling people, hey, this is a good low-risk entry point, and then guess what? The very next bar, it basically stops you right back out for a relatively tiny loss. That, in that situation, fine. Didn't hold like it's supposed to, moving on. You can see from those prior examples, it held by the close at like a champ, and that's the key word there is the close. We don't overreact to intra-bar activity. We focus on the closing values.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.